Hello, everyone. Welcome to today's session. Let's get underway here. Market conditions, as of yesterday, mildly bullish. Today, everything's getting hammered here. So we'll take a look at current market conditions. That's definitely going to shift that back to bearish if markets kind of hold where they're at currently. We did have a decent little move yesterday, a little counter trend back up, but markets have been digesting probably the Fed and their conversation yesterday, their lack of making a move, and markets have decided that they don't love that at least as of right now. So breadth indicator still positive as of now. We're seeing sentiment which is in the upper end of that range also. And again, as of yesterday, buy sell ratio still sitting bullish, 2.57, and that gives us that strength to the upside as far as the number of stocks that are participating in this current rally. Let's look what's going on right now, because we've got S&P 500 down about 1.5% and a gapping higher. So we got this move yesterday, moving back up and running into some resistance, and it just is immediately sliced right back through that level and is heading for that support area. Dow was down about 500 or 600 points. Pretty decent sell-off going on right here. If we look at really across the board, Russell also just really getting hit right here, down 4%. So this is starting to feel like a decent little exodus day. It's certainly a distribution day, and that is institutions getting rid of shares. So it's going to be a pretty significant day for some adjustment once the dust settles and we kind of see where we're at towards the end of the day. This may be a day of getting stopped out of a few things, and then once things close, we can make some adjustments, close things out again in the morning, or tighten up stop loss. So anytime we get into these bearish trends, and now we're starting to see where we're sitting kind of right at that area. Let's look at Dow real quick here. You can see how aggressive Dow is to the downside. This that equates to about 680 points on the Dow. So seeing a pretty decent counter trend move, and going to retest this 400 range on Dow. So again, we'll keep an eye on this. This is the early indication of some additional distribution days happening. And really, when we start to see everything getting tossed out, when you get just nasty down days like this across the board, and we're seeing it in NASDAQ. NASDAQ is down 3% as well, and retesting those areas. So this is some of the early phases of part of the conversation that we've been having now for the last few months is really what's happening here. We started to get this distribution on technology. Now we're down in this range, and so we were already bearish, which means we'd already been discussing how we should be positioned, how our allocation should look, and so this shouldn't be overly alarming at this phase. We're still in the longer term 1-year time frame and 2-year time frame for NASDAQ in the upper end of that range. Let's look at the 2-year time frame. Let's get rid of some of that volume just to give a little bit more perspective of where we're at in relationship to some of these bottoming patterns that we had a year and a half ago. 18 months ago was really when we started to bottom out. Things started to rally back to the upside, and we had a little bit of a retracement back here, potentially similar here happening at this point. But once this starts to happen, then we want to be participating the bulk of the uptrend here with a larger position, meaning our allocation towards stocks is a little bit higher. As that starts to retrace and move back down, our allocation into stocks, once we get into this hole and now we get into this bearish trend, I'm looking at the Qs primarily here, but we'll look at Dow and S&P 500 as well. But once that starts to happen, then we can start to say, okay, I don't want to wait and see if we turn into this continuation, or I don't want to hold on to potential losing trades for that, to wait and see if it bounces, okay, while we're holding on. Where we want to wait and see is we want to wait and see in cash. If we're stopped out of trades or have been stopped out of trades, now what we would be waiting for triple Qs is for additional confirmation, something like that. Okay, so right now we can be, for the most part, sitting on the sidelines with the bulk of assets, and should have been really during most of this move higher, we've been around 25% allocation into stocks and the rest sitting in cash. So pretty heavily, 75% to 80% in cash currently. And that's for moments like this, particularly when we start to get some indecision and we start to get some acceleration to the downside. This is still not overly aggressive to the downside or panic selling quite yet. Let me jump back here. Let's look at S&P 500. So here on the 2-year time frame for S&P 500, again, still working relatively tight consolidation range, but this is a pretty decent day to the downside. It can turn, we can get support and it can rally just as aggressively to the upside if there's new additional news happening, but it sounds like markets are digesting interest rates primarily, and that has been a little bit of a concern really for inflation and for the markets as a whole. Let's look at Dow also right here with this perspective and see where the Dow has been also just sitting in the upper end of this range right here. So we've been in the upper end of the range, starting to get some weakness. Now Dow has got some resistance there. It's been testing it. It counter trended up, tested this level. Now it's being rejected to the downside on a pretty aggressive day. Let's bump back to that 6-month time frame and look at sectors as well. As we bump over into the sectors ETFs, be curious to see. As of yesterday, we actually were starting to get a little momentum with a few additional of these sectors that were starting to gain some strength back into the upside. Let's look at starting with the top here and see what we've got. Basic materials seeing some resistance, still in the buy zone, not the momentum zone on a 6-month time frame, and we're looking at this upper momentum zone here. Starting to lose some traction there, particularly at this resistance area. So next real range of support is 142. So again, as we're going through and we're looking at, in fact, let me go this way and go so we can scan through these consumer services. Wow, that one's getting beat up here as well. So consumer services, although that was already in a downtrend, let me actually jump back and we'll look at it like this here as well, because we had consumer, what was that? Consumer services here from hold. So that was a hold yesterday and down 2%. So these are, these, when we talk about trend and counter trend moves, one study of Elliott wave patterns, there's 2 parts, and it's called a motive wave or the trending wave, and then the counter trending wave. And what a motive wave or a trending wave starts to unfold like is like this. Okay, so if we're in an uptrend, the trending wave is like this, and the counter trending wave is here. And then the trending wave is fast and it's solid and it's quick, and the counter trend is slow and it's consolidative and it's choppy, and then the trending move is like this. Well, it can work the same to the downside as well. Those trends, as they're unfolding, we have a downtrend, counter trend back up this direction, and then acceleration. Counter trend back up, slow, choppy, acceleration. Okay, you look here, downtrend, counter trend, acceleration. Counter trend back up with some choppiness, acceleration. So we're starting to see in some of these subsectors trends potentially starting to shift as these moves higher are counter trending and starting to be rejected, and then you get additional selling starting to happen. It's still in the shorter term, still on this time frame, we're still dealing with an uptrend. Okay, so we still want to be aware that there are support areas. We could find some support, and ultimately things could reverse and start to head back up again. But for the most part, right, where do we want to play? We want to play up here. So we're no longer interested in playing with some of these sectors, with some of these indexes, and with a lot of stocks right now too that are starting to break down on the 6-month time frame. Most of the time, if we would have been in a bullish trade, we're going to be getting stopped out around here, right around that 236 location. That oftentimes is right at a support area at that. When it fails, you can see where the underside of that now we failed. Now the underside of this location is creating resistance, and now we're back down here again. So let's let this, in most cases, let this chop around, do what it's going to do, create some volatility, decide which trend it's going to establish, and we'll sit it out. Okay, let's look at some of these others as well. In fact, I'm going to go back to, let's go to the rank here because we've got financials, which have been doing pretty well. So not, still 2%, but financials, you can see on that perspective, we would be interested in waiting to see what happens here for some support. Okay, so if we're looking at individual sectors and we're saying, well, which sectors may I want to focus on right now in the current market situation, then IYF, which is a financial ETF, is not that bad. It's not in that bad of a shape. Yes, this is a pretty decent sell-off, but may provide an opportunity for some support. It also could be, it also could be the beginning of some downside here. Typically, when markets, stocks, sectors are leading, the strongest ones are going to hold up the best, but ultimately the market as a whole ends up pulling everything down. So that was financials. We have technology. Okay, technology looks very similar to the triple Qs, which is basically technology as well. Industrials, this one should look similar to the Dow. Okay, Dow Jones Industrial. So we've got a pretty aggressive sell-off in industrials here as well, piercing through that 236 momentum zone. And if it closes there, then again, everything we're watching for are ranges, are zones. The path of least resistance for an uptrend is already in the upper zone, right? There's not a lot of resistance happening once we're already in that zone. We're looking for continuation of that. Once it breaks down into these lower rungs in the ladder, then we've got resistance. We've got potential resistance in a lot of different areas. And so once that happens, again, we're breaking down into an area that if we were in a trade like this one, we would start to be getting stopped out or very close to it, or looking to exit on the next day, just because now it's entering into an area that creates additional risk for our position for more downside. Let's look at utilities. Utilities here, interesting. There we go. So there is actually something that has got some upside here. So utilities, symbol IDU. Again, these are ETFs, and they're not leveraged ETFs. They're just the tracking ETFs. Most of these are iShare. So the company is iShare that these are, and there's so many of them now that have different ETFs, but the iShare for the most part is the biggest. So utilities, there's an interesting place. We're seeing money move into utilities, and that actually is an interesting. So you've got financials, you've got utilities, two areas of interest that are performing, at least as of right now. Real estate actually holding up here so far, and we've got consumer services, which is getting beat up 2%. We're seeing healthcare. Let's see, healthcare's actually been doing pretty well. So healthcare also getting a bit of an up day. So you've got financials, you've got utilities, you've got healthcare, and again, these are all, if you click on this sectors tab and you just go to the sectors ETF, these are all listed here, so you can do the same process that we're doing now. If you're like, which one was he talking about? Just go back and scroll through some of these. So that one was healthcare. Still some strength there. Again, this momentum zone here, 236, finding some support to the upside. So we're seeing some leading in financials. Even that real estate ETF was holding up. And telecommunications, interesting retracement past, similar momentum zone. So there's a couple of patterns. Just in the longer term trend, though, still may have, let's look at this 2-year, because this long-term trend is down right here. So you go out to that 2-year time frame. So now you get a little bit clearer perspective that even telecoms are, they've got some resistance to work on, even though they've been showing some strength right here in the last few months. Energy, oil had a big move yesterday higher. We'll go in and take a look at oil. So IYE, so we're seeing energy get also lagging here. Base materials, we looked at that one. We also looked at, did we look at consumer goods? So consumer goods, so this is a little bit different sector. This is one that you would expect to be moving a little bit higher as markets are getting weaker. Consumer goods, because typically these are stocks that are going to be, your Kimberly Clarks of the world, your toilet paper and your butter. Okay, Procter and Gamble, Coke, Pepsi, cigarettes, beer, mouthwash, more cigarettes, health, Kimberly-Clark is toilet paper. Okay, so consumer staples, those are your companies that are participating in this iShare, okay, in this ETF. Those are the companies. And again, if there is fear in the economy that things are reversing and maybe rates are not going to be coming back down and inflation is an issue, then a kind of a flight to quality, a flight to these kind of companies is not surprising. So that's an interesting, also another location that is showing some strength there in consumer goods. Global consumer, that one's been kind of nasty already and just getting worse. And then transportation. So transportation has been actually quite weak here as well. And again, stocks in the transportation average, if we take a look at that and say which ones, why would transportation be moving lower? If we take a look here at the holdings on this one, you've got Uber, Union Pacific, which is a railroad. You've got UPS, you've got FedEx, you've got CSX, which I believe is another rail line, Norfolk Southern, which is a rail line, Delta, which is an airline, Southwest Airline. So you've got kind of this combination of transportation with Uber, you've got rail, you've got delivery and FedEx and UPS, and you've got one airline in Delta in there as well. So also seeing transportation. And also oftentimes transportation gets weak in anticipation of a slowdown in the economy because there's probably not going to be as many things purchased, which means there's going to be less things that are shipped by FedEx, by the rails. And again, that's kind of the real broad-based perspective of why things start to move. But it's a leading mindset to say, well, it's and a lot of these big institutions just have algorithms that are they're just moving money daily based on some information. So they may say, okay, we have a model that is interest rate heavy when we think the Fed's going to do this, then let's move assets into these sectors and out of these sectors. And you also get traders that are trading these patterns and trading these averages based on the same mindset, moving money into one and moving out of another. And this is one way for you to kind of pinpoint a little bit closer as far as allocation and say, all right, let's go out of stocks, a little bit more individual stocks in a portfolio. If I'm managing the portfolio and I'm going to say, instead of having these be individual stocks, maybe I start to bump down to 15% or 10%, and instead of owning the individual stocks, I actually own the sector as well. So I could buy, this is what we were talking about here, consumer goods. Maybe I have a percentage of my assets that are allocated towards equities into a consumer good sector ETF instead of trying to pick the individual stocks. It just gives you one more layer of diversification. Doesn't necessarily mean it's going to work, or it doesn't necessarily mean it's going to be the right decision at the right time, but it does mean that instead of buying one stock, you're buying a little bit more of a theme, a little bit more of that theme that, the economy may be slowing, consumer goods typically don't slow, everybody needs toothpaste and toilet paper and beer and cigarettes, apparently, to ride out any difficulties, and that consumer goods ETF is a good one to go. Interesting place this conversation has gone into today, because there's so much value in utilizing each of these different tools in different ways. To say, okay, I want to own a portion of healthcare right now, but there's so many biotech names, and there's so many pharmaceutical names, and there's so many, all of these different companies we can focus on just the entire piece, just the entire area of that part of the economy, and say, I want to have a piece of my money specifically in healthcare. Here you go. Let's look at some of the names in that one and say, so here you testing audio, testing audio, testing audio, testing audio. Let's try this again. Testing audio, testing audio, testing audio. I am going to just play with some of this here. See if that is going to fix anything. Shoot. Okay. Well, I don't know what the audio. Audio. Oh gosh, dang it, you guys, I'm sorry about that. Was it off the entire time? Oh, well, shoot, that was got it now. Okay. You know what? Let me go another 10 minutes or so and just kind of rehash a few of these things here. Essentially, you were kind of following along there, but primarily what I was focused on is the sector ETFs, focusing on okay, so one audio is there, but not work, or it's working, but not well. Okay. Yes, most of it is off. We can hear you, but it's been off for about 5 minutes. I wonder if that was maybe just a network connection. Okay. Okay. Thank you, everyone. I'm getting some typing in there. The sound, it just could have been maybe I had a bad connection there for a minute. Okay, perfect. Thank you very much. I'll just kind of summarize here then, and we'll finish up. But essentially, utilizing the sector ETFs, focusing on one or two of those ETFs, utilizing those as a portfolio instead of, or using those as a part of your portfolio instead of all of the individual stocks. It allows you to be able to say, and hopefully you were able to see some of those names that we were looking at when we looked at consumer services, and say, okay, that's consumer services, obviously a different list than consumer staples. Let's actually look at that. I'm curious on this and see. Okay, consumer discretionary. Okay, that's why we've got Walmart, Netflix, McDonald's, Walt Disney, Booking, which used to be Priceline, Home Depot, Costco, Tesla, Amazon. Okay, Amazon's 15% of that, so that's why this one's getting beat up today here as well. And keeping an eye on some of those sectors to be able to utilize. Healthcare was working. We talked about healthcare. We also talked about utilities, which is also working. When I say working, it's just moving higher on a negative day, on a down day where the markets are getting beat up. The Dow, S&P, NASDAQ, there are areas that aren't getting beat up, and that's where some of the areas we want to be able to focus on and watch to say, okay, if things are getting a little bit rough in terms of an economic perspective, and you've got money moving into some of these areas, these are areas that if you don't want to be in cash entirely, but you want to have a piece of the pie allocated towards something, but not an individual stock, then some of these ETFs are also a way to be able to diversify out into that theme, into that idea. Apologize about the audio, and I'm not entirely sure what happened there, but everyone have a fantastic weekend. I'm going to end on that note, and we'll get this recording up as soon as it gets processed. Everyone, thanks for your time and effort, and we'll see you next time. Bye now.